Good morning and welcome to the Record PLC full-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and I would now like to hand you over to the management team of Record PLC, Dr. Jan, CEO, and Richard, CFO. Good morning to you.
Good morning.
Morning, everyone.
Good morning, everyone. So, very excited to be here today, and so we'll go straight into the presentation. And as I'll start with a couple of words about Record as a business, and then as we can see the questions as they're being submitted. So we'll try to take as many questions as we can as we go along. But otherwise, once we walk through the slides, and go through the remaining questions afterwards. So here on, if we start with slide 5, that gives a nice overview of Record as a business. I'm not going to go through all of the numbers, but importantly, we've been around for 40 years. So Record was founded in 1983, originally as an FX specialist, and from that basis has grown into fully fledged derivatives manager. So still a lot of what we do is overlay structures, derivatives options, and other sort of risk mitigation techniques for large institutional investors. And so assets under management as of this year are just over 100 billion AUM from investors in Switzerland is a big location for us, but also Europe in general and the US. So those are the 3 jurisdictions we focus on. But we do have clients in most other sort of global hotspots as well, such as Australia and Asia. How do we define ourselves? So in a sentence, we say we are a specialist asset manager, because what we do, what we offer, the products we focus on tend to be very specific. So we say we're a specialist asset manager, focusing on best-in-class products for large institutional investors. And I think sort of every word in that sentence has quite a lot of weight for how we do business and how we think we will continue to grow, in the sense that we are large now with our AUM, but of course we're still sort of a lot smaller than other much bigger houses. So what sets us apart is the ability to offer customized solutions at very large scale, and that's what we do. So we can deliver mandates that are in the billions. We can typically launch these quite quickly. Whenever we say we're able to follow through and do that in a matter of weeks, which is valuable to our clients. And because at the same time, with about 100 employees, we are still quite nimble and flexible compared to larger houses. So that's where our competitive advantage sits compared to the smaller competitors and larger competitors. It's that space where we can customize yet deliver at scale. So we're a bit more flexible than the really big houses, and that's of an advantage which we're trying to play as often as we can. Teams are located in Zurich, Amsterdam, London, and the US. So that's where, then again, in line with and Frankfurt, in line with where our clients are located. The hub really for us is based in London, where we're trying to have teams on the ground to look after clients wherever possible. And again, that's very much in line with our clients being large investors, which means that we have they're demanding clients. So we spend a lot of time servicing these clients. We have grown, particularly in the last couple of years. AUM 2019 was around 70 billion, and we're now proud to, as earlier mentioned, have reached 100 billion. So the business model has been working for us, and so in that sense, we're excited to now proceed very much in the same way as we move forward. We're regulated, just as the last sentence to the slide, we're regulated under FCA in the UK, and that very much allows us to then do business in the US, Switzerland, and Australia. But we're separately regulated under BaFin in Germany, which for us covers the EU. So that's quite important as a setup for us. In that really covers all of Europe. Also following Brexit, we have the licenses to be active here. But yeah, we can branch out successfully from here into the world. So if we take slide 6, let's briefly do slide 6. Yeah. So who are our clients? As I've mentioned earlier, who are the large investors generally in the world? It's predominantly pension funds. Yeah. So our client base comprises to a large extent of pension funds, followed by foundations and other asset managers. Yeah. So that probably describes almost the entirety of our client base. What that means, again, so in the light of what I described earlier in terms of what do we do well, when are we competitive, when are we able to win mandates, is when we're able to address the requirements of a client almost 100%. So really, you know, if there's any desire for something that's slightly streamlined, if you know the requirement is in its entirety to do it fast or at a certain price point, you know, there tends to be other companies who compete well. But when it's about having somewhat specific complex requirements and addressing them exactly, that's where we excel. And once we've done that, then that translates with high emphasis on service on our side into a very long-term client relationship. So what we see on this slide is the average time clients have been with us for, but so in a sentence, about half our AUM is from clients who have been with us for more than 10 years. So for us, these are you know, very valuable and enjoyable client relationships where once we work with an institution, we tend to work with them for a long time. That's and so this slide shows the products, the way we define them now. And again, this is something where we've done a lot of work in defining the product range exactly the way we see it here, in part also in response to the growth we've seen. So if we were to go back, say, 10, 12 years in the history of the business, then products would have been probably less clearly defined, and you know, so bigger teams would have simply addressed all investor needs. But with and so I think clients who are continuously demanding also what they expect from service providers, and also the growth we've seen, we now have structured the business very much along these 6 product categories, also almost 7 products, because custom solutions really falls into 2. But that's really the way the business is now positioned. That's the way we look after clients. That's the way the investment teams are structured, and that's also the way we structure the sales teams. And again, there's in the positioning of the business, it is important to have salespeople who are highly specialist in these products, and that means typically, salespeople do not cover a lot of these products, but at most 1 or 2, because we prioritize depth and specific knowledge in these products over covering the whole range in how we present to clients. So just briefly, it's walking through these products. On the left-hand side, we have the label risk management under the first 3 products, which is as I said sort of earlier, that's really sort of rooted in the FX history of the business. But this is taking care of managing the currency risks that international investors exhibit based on their international investment activities. So what happens is when a pension fund, for example, a UK pension fund has obligations through their pensioners in the UK. So they have to pay pensions to UK pensioners in sterling, but they will typically want to invest globally. So what happens is that, you know, between the international investments, and typically there'll be a large US position, because the US is seen as attractive, certainly in part, to the portfolio. That means there's now a risk from US dollar to sterling, and the pension fund needs to decide how to manage this risk. And they can either remove this risk in its entirety, which is sort of a passive hedge, which is the first box we see here, or they can decide to remove that risk, but at the same time pursue a value add from that strategy, which is the third box we have here, which is active FX hedging. And that's the two products which for us go back to really the early days of the business. So these are service-oriented products. They're very operationally focused products. Yeah. So if we take a passive hedging a mandate as an example, if $1 billion of FX risk has to be managed in these programs, then that as a part of the portfolio turns over multiple times over the year. So it's not quite the same thing as simply holding an equities position in a business, which once you've invested is on your book. But these are mandates where, you know, the contracts roll over and cash flows and also importantly then rebalancing has to be taken care of by us in delivering this as a service to the client. So in a passive hedging product, for us, that really means we deliver an operational service, and in a lot of cases, the value here really is from a client point of view that we do have all of the checks, balances, and operational sophistication in place to do this safely. So these are oftentimes things where, from the point of view of a team that outsources this to us, the risk for them to do that in-house is simply too large because there's very, very little tolerance for errors simply because of the size of these mandates. So to put that into context, we trade on the 100 billion or 102 billion of assets under management. Our annual trading volume is in excess of 700 billion. So that's three quarters of a billion. And 3/4 of a trillion, sorry, it's 3/4 of a trillion, so in excess of 700 billion. And on a normal day, would trade 2 to 3 billion in volume, and on peak days we trade 10 to 12 billion. So this is a highly trading and operation involved service that we offer. And again, there's not a lot of people who can do it quite as well and quite as safely as us, which is a nice competitive advantage to have. And as the label says, risk management, it's a nice part of the business in that it is relatively independent of market movements for us as a line of business, but it is really an operational service. So with the client jurisdictions that we have, that's a very safe part of the business for us, for as long as we do an excellent job. But we're not overly reliant on external factors, which is of course different for active strategies, where there's a desire to add a return, but there's more of a reliance on, you know, how does the world now change and am I correctly positioned? Hedging for asset managers, the second box is really a service that has evolved from this service for large institutional investors, the way I've just described it, in that the private market industry has grown hugely over the last 20 years, but especially over the last 5 to 10 years. And that means there's now an ever larger number of private market funds that receive investment, that are still growing and that are being launched. And again, it's part of the bigger movement from, there's a trend from public equities to private markets, but there's also big movements still in bank disintermediation that support these trends. But for us, it simply means that the more funds are being set up, the more funds are there which grow, the bigger the need for service providers like us to support these funds really in specializing on what it is that they do well. So if we take, say, private debt or private equity managers as an example, that's their business, or real estate. Their business is real estate, their business is private equity, their business is private debt. So when they launch these funds, typically there is an opportunity for us to take the FX services on these funds off their hands and take care for them of that, so they can focus on what is the core of their business. And so that's something which initially sort of grew organically for us, almost without us really noticing, because we started to offer that service really simply based on what we'd always done for pension funds and foundations, but which we've now positioned as a standalone product with a standalone team to really look after these funds as they evolve. And again, so puts us into a very strong position, because it's quite complicated as a service to do this, because the private market world has typically not a lot of cash line. So to offer a risk management service the way we offer it in an environment where there's limited cash, or where there's opportunity costs to this cash that's held in a fund, because real estate fund wants to hold as little cash as possible to be maximum invested in real estate, means that there's nice opportunities for us to do the risk management in an excellent way and be appreciated in that capacity. Active FX hedging, very much for us a service that we see demand for in the US. So US investors typically look for slightly more active services in the way they manage certainly currency risk. That's in part a function of the US dollar being a more dominant currency. So from the point of view of a US investor, they do have foreign exchange concerns, but they're typically smaller than from the point of view of a European investor, because they're already majorly invested in US dollars. So they can take a slightly more active role in what is a smaller concern in the totality of their portfolio. But again, for us as a London-based business, it's a great market, because language-wise and culturally, it's a great fit. And again, we've seen that part of the business grow. So we've hired in the US, and we're supporting those efforts. FX Alpha moves us over to the return-seeking strategies. FX Alpha is really the question: how do I trade currencies globally if my sole objective is return generation throughout very much any environment I might face in the future? For us, that's expressed in our multi-strategy product, which is a product that combines several systematic return streams, most of which have been live since 2009 or 2012. So we have a long track record, and to date, strong performance. It tends to be smaller mandates, because the size of the mandate is not informed by the size of an investor's international asset allocation, but is typically informed by how much risk do they want to take compared to what we compete with here, which might be hedge funds or other CTA strategies. Yeah. So these are typically smaller mandates, but again, so it's something that we've seen a lot of interest in. Again, in part, I mean, a lot of the conversations we're having here is really clients also reacting to geopolitical tensions and political uncertainty around the world, and a bit of a movement around. So there's sort of a sensation of, sort of certainly globalization has come to a bit of a stop, if not reversal. So people's views, investors' views around these themes tend to diverge a little bit more. So we tend to get more inquiries where there's a question, can you implement a view exactly the way I sort of perceive these risks, or exactly the way I assess these opportunities. Just at that point, before I move on to the asset management range of products, almost everything we do is I'm not going to say entirely systematic, but there's a strong systematic core to everything we do, from active hedging to FX alpha, but also to sort of, the passive hedging processes. Is there's a lot of optimization, but also systematic cores to these strategies. Yeah? So we're not very much a discretionary portfolio manager, but a systematic and process-driven portfolio manager. Again, with the intention very much of giving clients a stable experience throughout a number of years, and avoid any sudden changes to the service or investment experience they receive from us. Right-hand side in blue at the top of asset management products is sort of a more recent additions to the product range, and in most cases is related really to things that we've done for clients, or that we've services that we have been delivering for investors, where then over time they grew in a way that enabled us to turn them into standalone products, and where we feel now this is important for us, this is big enough for us to have a team focusing on that. And there's a first example being the EM Sustainable Finance Fund, which here it says EM Debt, but it's EM Local Debt Fund, which we launched in 2021 in collaboration with UBS Wealth. And here the goal is to, through the deliberate use of FX contracts, or very much by de-risking the investments of multilateral development banks into emerging and frontier countries, to not only create a portfolio that's attractive from an investor's perspective within that asset class. So as a product, this runs against the usual benchmarks in EM local debt. So we'll run against a GBR-EM as a local currency benchmark, and has done very well. So I think it's up 20% since inception. But what the team does, and we now have a standalone team really sort of dedicated to this product. So they work closely with the multilateral development banks and development finance institutions in assessing, when are investments into emerging and frontier countries made, and what's the need to really, take the currency risk as part of these transactions, and house that in a diversified portfolio such that the recipient of these loans can receive a loan in local currency. So this is all about ensuring that someone who borrows in Georgia can do so in Georgian lari, doesn't have to do this in US dollars. And the multilateral development banks are limited in their ability to take FX risk. Limited, as this is an overstatement. They're not able to take any FX risk. So there's a need for the market or funds such as ours to absorb that FX risk, so these loans can be made in local currency. And then just sort of very briefly, infrastructure equity, so we've mentioned before, is a fund where we're looking to launch this year, and which we're very excited about. And private credit is a second fund again, which we're looking to launch this year, and that will then complete the whole product range. So that's the way we view the product range for the foreseeable future, and efforts are very much so making sure that the business is optimally structured behind these products. Yeah, but it's these products that we believe form a good basis for the business going forward, and also for growth going forward. If we very briefly look at the next slide, and just in terms of giving a bit of a background, in terms of the market opportunity here on this slide, we see on the left hand side that assets under management in the pension fund industry continue to grow. So this is in part due to an aging population, but it's also a lot of consolidation in the industry. But AUMs across then our client base are reaching ever higher levels, and just in terms of the service we offer, that means there continues to be opportunities for us to do what we do well, which is best in class bespoke solutions for large institutional investors. Yeah, so there's a big opportunity set here for us to have these conversations. We're also slightly helped, as I said earlier, by the increased global, not going to say tensions, but certainly anticipation of changes globally. Yes, that's certainly something that helps us, that has an effect on the currency market, the way it's viewed, but also the way the world is viewed, and sort of anything where really opinions diverge means we have opportunities to assist with implementation of what clients are looking for. Right-hand side shows just the last couple of years of growth in private markets, and that is projected to continue. And then for us, that means that then the second box on the product slide, as described earlier, sort of hedging as a service to other asset managers continues to be something where really the client base is ongoingly increasing, but separately then the other funds which we're launching or have launched, which includes the EM Local Debt Fund, the Infrastructure Equity Fund, and the Private Credit Fund, are very much products that are also participating in this set of opportunities. So broadly, just with these two charts in mind, we're quite happy to have a bit of tailwind here on both sides of the business, on the risk management and on the forward return side.
Just finishing on products, there's a couple of questions. There's a few questions we should get to, but I'm scanning through them. There's a couple on crypto. So I guess in recent years, the crypto, we had some crypto products that we were looking at, and also some of the funds that were related to that.
So I mean, if we go back to the product slide, then so yes, so crypto's not on there, and so we've discontinued our crypto efforts. Two things coming together really as a basis for that decision. One is certainly that maybe a couple of years ago there was a notion that crypto was related to currency, and on that basis we thought it was important to watch that space. But the bigger, and then I think that's changed. I think crypto is not really a thing of its own. But I think sort of more importantly, if we look at the product range as presented here, with where we are competing, really, as I said in the beginning, our competitive advantage really centers on large mandates. Yeah, so anything we do is our efforts should focus on large opportunities, and when we structure large investments, and then also typically these are relatively large opportunities for us in terms of revenue, and so that puts the hurdle for us relatively high for when we allow ourselves to do something new, because anything that we add to the product range comes at the risk of distracting. It creates there's a complexity premium that we pay in the group structure in doing these things, and so just in light of those risks or disadvantages, to when we do new things, we're being very disciplined when we say this is an opportunity big enough for us to really feature on this as part of this set of products, and our decision was that crypto just didn't meet that bar as in size of the opportunity for us, and I mean, so we exited those. We ended those efforts, but there was no cost to the business in doing so.
Anything else you want to cover before we come on to some of the questions?
No, I think that sort of concludes everything I want to say. Very happy to go into the questions. Yeah.
Perfect. Jan, Richard, thank you very much indeed for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right corner of your screen.
Yeah.
Now,
First question here is U.S. expansion and best strategy to avoid clients switching to passive mandates. I think I in part touched on it earlier, but the US really for us is an opportunity, and it's important to contrast that with Europe in that Europe hasn't benefited from Brexit. Neither the UK nor the EU have benefited because that separated London as still the de facto financial center from the rest of Europe, but also in the EU, selling into the EU is made additionally difficult by the separate jurisdictions around countries, even within that as a regulatory jurisdiction. So there's a need for example, funds, when new funds are sold into the EU, to be passported in the different countries separately before they can be sold. Whereas the US is very much one set of opportunities, one language, one culture, and so in that sense, we're very confident with regards to the expansion. In the US, and secondly, important to remember, we do have relatively large assets now in the US, and we are known quantity to a lot of the community there. So this is not something which we're starting. This is something which we're intensifying. And then just on the point of do we think there's a particular risk of clients switching to passive mandates? Probably rather the contrary. I think again with a light on how we see the world develop. There's probably a tendency which we observe towards slightly more active implementations, if anything, at the moment.
The context of that question is of course that our revenues
sure.
this year and will be in the coming year because of one particular client switching their mandate. But I think it's right to say that these are long-term client relationships and changes in the approach of investment managers and so on can change over the life of those contracts.
Yeah, they can always. Clients can always, of course, change what they do, and we will always support whatever the client wants to do. But we've not had any other instances of that happening, and in this case, this is after a 2-decade relationship with that client, and so really it's a change of team on their board with a different philosophy in terms of how to do things. So I don't think there's any data in that. In terms of what might happen in other jurisdictions and with other clients. Yes, so what measures are in place to ensure a smooth transition and continuity in leadership, especially given the long tenures of previous key executives? So we are proud to now be in a position to have managed succession, not only CEO and CFO succession as of you presented to here today, but also across all other teams. So we now today have a team in place across the product range where almost everyone has another 10 or 15 years ahead of them in terms of what's typical career horizons. Yeah. So we're in a position where we can commit to multi-decade relationships with clients in a way that's honest and believable. And we think that's very different from where the business was just a few years ago, where really we did have questions from clients. What happens when ultimately Neil steps out? What happens when ultimately Leslie will retire? So now we're in a position where we have completed that. I come into this job having previously been a global head of sales. So again, there's a close relationship with clients, and for me also through the board at RCML, at the Record Currency Management, and there's now a lot of confidence on our side that not only do we have continuity for a long period of time into the future, it also changes how the business now looks forward. Yeah? So it gives the business at all levels a much longer horizon and looking forward, how we plan, how we think, and so, in our ambitions. How do we manage that? I mean, a big part of that is share ownership. So one of the advantages of being listed is that we can ensure that all key individuals have shareholdings in the business and then so participate in their journey very much the same way our investors do.
I just add that, I mean, that whole transition process, the succession process, has been very actively managed and sort of quite publicly in terms of externally with shareholders and investors, but also with clients and so on. And I mean, obviously, I've come in new. You've been here a long time. Neil and Leslie, remain big shareholders of the business and been very supportive of the transition as well. So it's been very actively managed and thoughtfully done.
Yeah, I think it's one of the benefits of being a listed company is that these things are so very deliberately planned and then also executed, and it avoids some of the challenges that we see in sort of private companies. I mean, there's a lot of smaller companies with very much a CIO/CEO model where succession is something that just never happens, and that's what we're proud to be in a different position. Hello, as part of the risk management products, what is the risk taken by the company? Well, we manage. I mean, I described that earlier. We manage sort of sophisticated operational processes. Yeah. So ultimately, what we do is we take operational risk in the services we deliver, and it's our business to ensure that our operations are strong, cutting edge to minimize any leftover risks. We also ensure that the way we set up any mandates with clients minimizes these risks. Yeah. So again, this relates to the core of the business being systematic. Yeah. So most of what we do is process driven from the point of data collection at the side of the client, where in most cases we have access to custody accounts or even underlying portfolios with other asset managers on the side of the client. So we access that data, and then from there that data gets processed on our side, gets translated into the necessary trading instructions, and then sort of implementation follows. But it's really that process where we need to manage that process in an excellent fashion, and we do manage that process in an excellent fashion. But that's at the core of what we do.
There's a few questions. A question here about
On
an update on IT development. There's a few questions around bringing IT in-house, some of the things that have happened now.
Yeah, so I mean, there's a couple of the things. I mean, it also touches on office location and I think working from home versus working in the office. But so if we go back all the way to Corona, really the fact that for a period of time everyone was working from home, for us that really meant that that's probably the reason that today we do have a London office, and we're now sort of expanding the London office, and then we'll gradually wind down the Windsor office and make London our head office, very much with the intention now over this year and next bringing everyone back into the office. And that wouldn't have been possible had we not had the experience that the business can also function when everyone works from home. So for a period of time that works quite well. In terms of moving relatively fast as a business and also developing new systems and technology, there is a big noticeable difference between people being in an office and collaborating and people working remotely. And again, I mean, there's nuances to this. I mean, the more conservative amongst us, they would say, and that means everyone should be in the office for 5 days, whereas other people say it's 3. And again, I don't think there's necessarily right or wrong between these two opinions, but the the fact of the matter still is that when people do spend a lot of time together in an office, be it 3 days or 5 days, we do see different dynamics in developing new things, well, in collaborating, in being innovative, and being excited. So there's different levels of energy to that. So we did make the decision on that basis to bring IT in-house again after a number of years of working in a hybrid setup where we had a relatively smaller in-house team and a large external team of developers. And ultimately, so we didn't think that was the most efficient way of doing it. So we ended our relationship with the external team, and are very excited now with the internal team we have. And again, there was an opportunity for us to bring both a head of technology and a head of development into the business in a form where they had worked together in exactly that composition for 10 years previously at another business. And we decided that was sort of close to the best setup that we might have.
And there's a question also around the impact on operating costs of bringing IT on in-house. I mean, we've this looking at this current year, we expect our costs to be flat. That includes funding that IT development team in-house. And although we obviously, as you'll have seen from the results during the year, we some of the previous IT capitalization, which we wrote off, which was really, again, one of the things that Jan did pretty soon after coming on board, was looking at that, and as he's sort of just articulated, that wasn't an approach that was really working well. So I think it will be ultimately positive on operational costs. And I think my observation is, as you described, the bespoke operational and IT platform that we operate, having our IT teams there. And again, my other observation on day 2 as CFO, but I've been here for a couple of weeks, is just how client delivery focused everything that everyone does is, and that the IT teams are completely aligned to that, which I think this approach now is much better. So.
Yeah, I think in other businesses, if there's a lot of asset management business where the core of the operations is more generic. Where if a lot of asset management business will really differentiate themselves through the portfolio managers they have, and have very similar middle and back office operations. For us, as Richard says, almost everything we do is highly geared at doing exactly what our clients expect us to do, and in that sense, it's important for people to work closely together for that knowledge to be shared efficiently. So here, how is the strategic review progressing, and what are the initial findings, and when do you expect to publish the full outcome plus implementation period? So we'll do that on an ongoing basis now. So we'll communicate quite actively on that. I mean, the first step very much is the chart here we're looking at, and a couple of the decisions coming from that is then the earlier described decisions on crypto. There's also a couple of other smaller things which we stopped doing, which are not on this chart, which really we felt were at the risk of distraction. So what we're looking at here is really these are all products which have been very successful for us, and on that basis, should receive a lot of attention, or sort of in select cases where we think they will be very successful for us. But the first step of that strategic review was very much deciding on what this list should be, and we've now started to set the teams up in line with this product range. So there's now a very clear responsibilities, and then also accountability for the teams, which includes investment team members, sales team members, operational team members for each product. And there's those nuances between the products in terms of what's important. And so we'll much more deliberately manage the business by product going forward, and that will also allow us to then, in essence, the way we communicate, to share what's working well, what's being revisited in the individual products. But so in the last say year, we've been lucky that all of the products have been performing very well, which is also the reason for strong performance fees that we've received. So, in on that basis, we're in a strong position with strong product performance and assets at an all-time high. But as we grow as a business, that discipline of really doing only the things that allow us maximum effect is important.
A couple more. Do you want to took this one around? How to think about movements in AUM?
Let me read that.
Yeah.
That's a long question. Yeah, I mean, so we are always, assets under management for us is always affected a little bit by market movements, for example, in equities. So if we were to see, sort of a large, say, drawdowns in equities, and typically that has an effect on the amount that a client will want to hedge. So there's a bit of a risk there. And if we were to only look at AUM, there's a bit of a risk there that AUM can always sort of reduce a little bit if equity markets reduce, and that's just the nature of the business we're in. The increases in AUM we've seen were in large parts due to inflows. There was a contribution from AUM movements, but it was also the large part of that was new mandates. And this time around also in sort of the inflows of last year, it was quite diversified inflows across the product range. So that was inflows from several products. Whereas, I mean, the last noticeable, so we had a real sort of strong move up in AUM last time was 2020, 2021. And back then it was less diversified. But so in that sense, there's always, I mean, so if markets move, then sort of AUM could come down a bit, but it's not something which I would say worries us particularly. Again, because that effect would materialize really sort of on the risk management side of the business. And as I said earlier, that side of the business we manage in a very stable way throughout market environments. Yeah. So I wouldn't see that as a risk to the business.
But I think even with that movement in AUM in any sort of short period of time, those bigger term trends that you talked about in terms of both in the pension asset side and the private market side, those we've seen very strongly, and those continue. And so over a medium term time period or a slightly longer time period.
Yeah, well, a medium term period, the mandates we receive from clients are increasing. So because pension funds are increasing in size.
One question, I think, at the bottom here.
Will we ever see Record developing a retail product? I don't think so. I mean, what might happen is, I mean, so and again, so I think very very much in line with what I said earlier. We've really here set up a range of products where, and again, it's important to keep in mind, we're not that many people in the business. We're about 100 people, but we heavily rely on so really the quality of our people and to deliver the quality of service that we deliver. So it's important that our business model in terms of how we plan to grow is scalable in a ratio between new mandates and an expansion of the skill set internally that is manageable. And if we were to go down the retail route, then that balance would be right. Yeah, and I mean, so in the discontinuation of the digital efforts, those were institutional efforts, and we still sort of decided they were too small, really, in light of the big opportunities we see on the institutional side. So I think our advantage really is that we can do things very well, and we can do them very well at scale, and so that's what we focus on. Yeah. So don't see a retail product on the horizon. What might happen in a number of years, there might be situations where we would make, say, our execution engine available to, for example, an existing retail business. But again, that would then face us very much as an institutional investor. Can we add salespeople to increase AUM? How do you ensure you get in at the creation of new funds to be the risk service for us? Good question. It's a good question. So can we add salespeople to increase AUM? Yes and no. Yeah. So I mean, of course, always we can add salespeople and we can hope to increase AUM. For us, it's also important what do we ask these salespeople to do for us? And I think a big evolution for us as a business is, as I said earlier, the fact that we now hire salespeople into products. We've moved away from a sales team that would cover everything, because we don't think that gives the clients the optimal experience, and it's hard to equip salespeople then with the required knowledge. So that means that by product we can also then hire people with slightly different backgrounds, and in that sense there's slight differences in how then a sales process works depending on whether the prospect is an institutional investor, is another asset manager. But in almost all cases, it's quite important to be in ongoing conversation with prospects over shorter or longer periods of time. And really, that's the only way of ensuring that at the inception of new funds, we are a known provider. And typically that has worked quite well in the jurisdictions where we've followed that approach. But again, it means that we want to choose our jurisdictions carefully. So that is what for us in the UK, it's what for us in Switzerland, and we're focus on the US in that sense. But we would risk, if we were going too light in our sales efforts, then we would exactly experience a risk that the question here implies. And there's a risk that you're sort of half known, but you're not sufficiently known to the prospect to actually reach out to you when they need that particular service because they're now launching a new fund or product.
I think there's only one or two other. Is this question just coming in?
How do you see the product mix of lower margin and higher margin evolving over the medium term? So if we again look at this chart, we do have differences here in margins between, say, left-hand side and right-hand side. It's important to keep in mind that we don't design this product range purely to maximize margin. So with the we want to grow in assets, we want to grow in our client base, and we want to be around for a long time. So we want a product mix that gives us longevity. So margin is one parameter, but there's also the question, what makes for product mix here for the company that is stable throughout all environments that we might exhibit. And then again, importantly, that gives us client longevity, very similar to what we've had and which we discussed on the earlier slide. So yes, there is a movement towards the higher margin products, simply because the new products are on that side of the spectrum. Yeah, but at the same time, we're very focused on growing the whole product range to maintain the mix that we're envisaging.
I think that's it for questions. Oh, there you go. There's one more there.
What's a typical visibility time frame on the gain or loss of a large mandate? So in gaining or winning a large mandate, you typically have some kind of information 6 to 12 months before it goes live. But it's often hard to say until sort of a couple of weeks before it launches if it's actually launching or not. Yeah. So we at any given point in time we manage a number of conversations that could potentially go live and be very large for us, and some of them just stopped for a lot of reasons, and some of them then suddenly accelerate and move in the right direction. In terms of the loss of a large mandate, again, touch wood, that hasn't happened in a while for us, but typically also there is a conversation that had probably 6 months or longer, where the client, again, so in these types of services that we offer, if a client was to decide to discontinue working with us, we hope they don't want to make that decision, but there would need to be some preparation in terms of now who is going to continue offering that service, and so that conversation would typically start ahead of time.
That's everything. That's everything for questions. There are one or two questions that we may just get back to people on, but I think we've covered most of the questions.
Perfect. That's great, Jan, Richard. Thank you for addressing those questions for investors today. And of course, the company can review all questions submitted today. I will publish those responses on the Investor Meet Company platform. But before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Jan, could I please ask you for a few closing comments?
Closing comments. I think both Richard and I are very, very excited to now steer this, lead this company going forward, and we're very excited about the opportunities lying ahead. And it's a privilege, I think, to have this opportunity to grow what is a wonderful business, and also to do that starting at an all-time high of assets. Yes, so I think we're starting at a very strong point for a company, and we'll do everything we can to deliver from here.
It's also the first one of these investor meet that you and I have done.
Absolutely,
First one that we've done together, and it's great to have the opportunity to speak to so many people as well. So thanks very much for everyone for joining the call, and hope to speak to you all again in future.
Perfect. Jan, Richard, thank you once again for updating investors today. Could I please ask investors not to close this session, as you will now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of Record PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.
Thank you.